The money in your bank account does not actually exist. When you check your banking app, you see a solid number. You assume those digital digits correspond to physical paper. They do not. If every customer at your bank walked in today to withdraw their cash, the bank would freeze. Because they only keep a fraction of it on hand to satisfy daily liquidity. Our modern economy operates on fractional reserve banking. Banks create new money primarily through the act of lending. When they issue a house mortgage or a business loan, new deposits are effectively created throughout the system. There are strict rules on how much they can lend out so the system doesn't instantly collapse, but the core reality remains exactly the same. A dollar bill isn't backed by a vault full of gold anymore. Money is simply a collective psychological agreement. It is a massive, fragile web of public trust. The dollar only works because everyone wakes up and collectively agrees it works. Most people spend 40 hours a week trading their actual finite lifespan for these digital numbers, but they have absolutely no idea how the numbers are created or governed. I'm Chip, and today, we are breaking down the invisible architecture of the financial system. There is a very common narrative on the internet that the economy is a shadowy conspiracy, a system secretly designed by a handful of people in a dark room to keep you intentionally poor. The reality is far more boring, and honestly, a lot more intimidating. There is no grand conspiracy. It is just a massive system built on everyday human habits, legal loopholes, and the drive to make a profit. The system doesn't actively hate you. It is just completely indifferent to you. It simply rewards certain financial behaviors and ruthlessly punishes others. Let's look at the core engine of how this economy functions. The global system relies on constant economic growth, continuous lending, and productive activity to service existing debt. Without new value creation and new borrowing, the gears of the machine grind to a halt. The modern economy was designed to incentivize consumption. It needs you to buy things, upgrade things, and discard things at a rapid pace. And over the last few decades, it became incredibly efficient at getting you to do exactly that. Not by force, but by targeting human psychology. This brings us to the most effective behavioral trap ever designed. You are not naturally bad with money. You are just operating in an environment completely optimized to separate you from it. From the moment you wake up, algorithms present you with a curated feed of alternative lives. You see your peers dining at expensive restaurants and driving financed crossover SUVs. You feel a very real biological pressure not to fall behind the pack. And the financial sector provides a frictionless solution to that social anxiety. Borrowing money to fund your lifestyle is essentially financial time travel. It is the most dangerous psychological trick in the modern economy. When you swipe a credit card for a luxury item you cannot afford in cash, you are literally pulling forward your future labor. You get to experience the feeling of wealth today, but you force your future self to pay the bill. You are actively stealing financial options from the 40-year-old version of you, just so the 25-year-old version of you can look successful at a dinner party. The credit system lets you consume the lifestyle before you have actually earned the capital. And that is exactly how people trap themselves in comfort. Because while you are spending the next 5 years paying off that auto loan, you become incredibly risk-averse. You cannot quit a toxic job because you have a $700 payment due on the 1st. You cannot launch a business because a temporary loss of income would ruin you. You traded your actual, literal autonomy for a piece of depreciating metal. The modern corporate structure heavily benefits from this behavior. An employee with a massive mortgage and rolling credit card debt is highly predictable. They are terrified of losing their income, so they will never negotiate too hard, and they will never walk away. If you are currently carrying consumer debt, you do not need to drown in shame. Do not sit there and label yourself a financial failure. You fell for a system that was specifically engineered by incredibly smart people to make you fall for it. They removed the physical pain of handing over cash. They gamified the apps to give you a dopamine hit when the payment clears. They normalized carrying a balance from month to month, but once you see the mechanics of the trap, you are responsible for climbing out of it. So what do financially independent people actually do differently? A lot of people think the wealthy hate debt. The truth is, wealthy individuals and institutions carry massive amounts of debt, but they completely understand the difference between borrowing to buy things that lose value and borrowing to buy things that make money. They use leverage as a calculated surgical tool. They do not use it to subsidize their lifestyle. When average people borrow money, they borrow it to consume. They finance a vacation or lease a car that loses 10% of its value the second they drive it off the lot. Their personal debt goes up, but their actual net worth stays completely flat. When financially savvy people borrow money, they borrow it to acquire productive assets. They take out a loan to buy a business, acquire real estate, or fund a cash-flowing project. Their debt goes up, but their asset base goes up significantly faster. And here is how the tax code creates a massive divide. The interest you pay on your personal credit card is a penalty paid with after-tax dollars. The interest an investor pays on a business loan is frequently a tax-deductible expense. The exact same financial tool is used in two completely opposite directions. When you use debt to buy clothes, it limits your future time. When an investor uses calculated leverage, it accelerates their timeline. But make no mistake, leverage is just a tool, like a chainsaw. If an investor uses it recklessly and the market turns, that same debt will completely wipe them out. The difference is, they took the risk to build wealth. Most people take the risk just to buy a nicer couch. The problem is that the average person never gets to the asset accumulation stage. They are too busy treading water, trying to service the interest on their consumer choices. By the time they are 50, they finally start thinking about investing, but they have lost the most valuable variable in the financial equation: time. Compounding is one of the few financial forces that becomes exponentially more powerful with time instead of less. A 25-year-old investing a couple of $100s a month will effortlessly outperform a 40-year-old investing triple that amount. You can always earn more money. You can never buy back the decade of compounding returns you lost while paying off a car. Knowing how this massive game works is only the first step. Understanding fractional reserve banking doesn't magically pay off your credit card, but it gives you the psychological armor to look at a billboard and feel absolutely nothing. When you realize the guy revving his engine at the stoplight is likely drowning in a high-interest 72-month auto loan, you stop being jealous of him. You realize that true financial security is silent, invisible, and completely unbothered. So here is the concrete, step-by-step protocol to actually escape the trap. Step 1. Stop the bleeding. You cannot outinvest a credit card that is charging you 24% annual interest. There is no index fund on earth that reliably returns 24% a year. If you have high-interest consumer debt, consider it a financial state of emergency. Pause your investments outside of a company match and aggressively attack the highest interest balances first. Every dollar of high-interest debt you pay off is a guaranteed, risk-free return on your money. Step 2. Audit your behavioral triggers. Look at your phone right now. Unfollow every single influencer, brand, or peer that makes you feel like your current life is inadequate. Your attention dictates your desires, and your desires dictate your spending. Implement a mandatory 72-hour rule. If you want to buy a non-essential item, put it in the digital cart and walk away for 3 days. 90% of the time, the dopamine craving will pass and you will close the tab. Step 3. Buy a piece of the casino. Once your consumer debt is cleared, you have to transition from a consumer to a producer. Take the exact same monthly payment you used to send to the credit card company and route it into productive assets. Broad market index funds, real estate investment trusts, high-yield savings. Treat that investment transfer exactly like a non-negotiable monthly utility bill. Pay your future self before you spend a single dollar on your present self. You cannot dismantle the macroeconomic banking system. And honestly, you don't need to. You just need to stop playing the specific game they designed for you. You can choose to let your capital work quietly in the dark, while everyone else exhausts themselves trying to look wealthy in the light. Your financial peace is entirely in your hands. I'm Chip. Pay off your debt, buy assets, and stay unbothered. See you in the next one.